Gold has had quite a remarkable year. As I record this video, if you had invested in an ETF, an exchange traded fund, your returns year to date would be about 26%. And you've probably seen adverts in your social media streams or perhaps through the post for buying and selling gold because it's so much in demand at the moment. I'm Andrew Neligan, and in this video, I'm going to look at whether gold is actually the panacea investment or whether, as someone who's planning their retirement and investing for the long term, an alternative approach may be better. So what we're looking at here is the relative performance of gold, the spot price of gold, which is what gold is bought and sold at on a given day, compared to the returns of the S&P 500. The S&P 500 is the 500 largest publicly traded firms in the US. So when I say publicly traded, they're listed on the stock market that you and I and investors around the world can buy and sell within our pensions and our investments. And the S&P 500 is, by size, the largest stock market in the world, so it makes a great comparator in its performance relative to gold. And what we're looking at here is the returns from 1999 to current year 2025. Blue line being gold, red line being the S&P 500. And you can see that gold looks like it's the hands down winner. If you invested in 1999 all the way through to today, you would have beaten the S&P 500 by relative ease. And what we know about gold is when we go through periods of uncertainty, geopolitical uncertainty, socio-economic uncertainty, investors take fright of that volatility that we see in stock markets, the fall in value in stock markets, and see gold as a safe haven asset. And that is when gold does particularly well. So if we think back from 99 to today, what we've been through, we had tech bubble bursting, we had 9/11, the second Iraq war, then we had the banking crisis, the great financial crash of 2008, when governments and the Federal Reserve, the Bank of England, the ECB in Europe had to step in to save some of the world's biggest banks from collapsing. And that led to the sovereign crisis when it looked like the likes of Greece, Portugal, Italy, Ireland, Spain were all going to themselves become bankrupt. So huge risk geopolitically, socioeconomically at that period of time. So gold surged in value. And then we had COVID, and then the invasion of the Ukraine by Russia and the effects that had on inflation. And then finally in 2025, we've seen Trump trying to enact his various policies, particularly the tariffs that they've been trying to force upon countries around the world. And so when we go through these big events, gold typically does really well. But what this chart doesn't show is what underlies all that when we look at different time frames. This is just looking at 2 points in time, 1999 to 2005. But that can cover a lot of ills. What we need to do is be able to drill down and say, well, what's happened over different time periods? What are the effects of different economic cycles and different events, periods when stock markets have done particularly well compared to gold? How does that change the picture? And that's what I'll cover in the next chart. And that's when rolling returns come in. And what rolling returns do is they look at multiple different time frames so we can more accurately compare two investments or multiple investments to see how they did under different conditions. So, for example, if we were looking at 5-year rolling returns, as this chart is doing, we'd look at different monthly returns. We look at January 2020, for example, up to January 2025, and we look at February 2020 to February 25, March to March, so on and so on, as we go through up to present time. Lots of different 5-yearly periods on a month-by-month basis. So we're getting much more rich data by looking at. And if we look at this chart, which compares 3 different investments, we've got gold, which is the orange line, green, which is the S&P 500, and then a blended portfolio, typical portfolio that an investor in the markets might have, which is 60% in in global stock markets and 40% in global bonds. So a 60-40 split. Now you could split that allocation any number of ways, but that is broadly typical for someone who wants a balanced risk profile. And what we can see here when we look at this, and this is looking from 2004 up to 2025, is how gold suddenly looks a lot more volatile. It is negatively correlated to stock markets. So when, as you can see in 2008 here, you can see when we had the banking crisis and the value of stock markets and government bonds around the world fell sharply, gold, because it's that safe haven, did particularly well, and it rallied, and it had some stellar returns. But then you can see some stellar falls as well. So very, very volatile. Whereas, yes, the S&P 500 had periods of volatility, 2008 and 2020 particularly, and then now 2025 with Trump's tariff and that effect. But you can see the range of returns is much narrower than gold. And if we took a more blended approach, the blue line, that's 60-40, as we'd expect when we diversify, we're giving up some of those returns, but we're getting much less volatility. So that range of returns is much narrower, which is more appropriate for people who are looking for that long-term investment return, but can't quite stomach the big swings and just investing in one particular market. And then when we expand the picture further and say, well, what's happening over a different 10-year time periods to get a better idea of how different assets perform over the much longer term, you can see, yes, the effect of gold, the volatility of gold is smoothed out, but we can still see big falls. So there are periods when, as an investor in gold, you're very disappointed. You're seeing the value of your investments fall. Whereas you can see the S&P 500, the 10-year returns trending upwards. Still, we get these periods of volatility, 2020 with COVID and 2025 with Trump's policies, but much more positive range of smoother returns as well. And again, to complete the picture, that blue line, that 60-40 split, positive returns and with much less volatility. And so when we're thinking about long-term investing, we don't want to make the mistakes that a lot of people do, which is be buying assets where they're high and selling when they're low. We have something called the behavior gap. It was originally coined, the phrase behavior gap, coined by a financial planner and author in the US, Carl Richards, and that explains the difference between market returns and investor returns. And normally, for most people, because of the emotions that go on around investing, when they tend to do the wrong thing, which is buy high and sell low, there's a gap in performance between what the actual market did, whether that's the shares, stock markets, or gold, or any other assets. So higher returns of those compared to what the actual investor receives. And this slide is something I created a number of years ago just to explain that emotional roller coaster that we can go through, which typical investors go through when they see assets rise and fall in value. And that's typical of gold when people go through these traumatic events such as global pandemics and global economic uncertainty. They'll see gold do really, really well, and they'll get greedy and think, I want some of that, I'm in, look at how everyone else is doing, let's have part of that. And then they'll come over the crest of that, and they'll see the value of their investments fall to a point that they get more and more worried and scared, and ultimately typically sell out at the wrong point. And then they repeat that cycle, possibly straight into the next investment that's doing well, or they're waiting for gold to do really well again, and they'll pile in at the wrong time as it's reaching its peak, only to sell at the bottom. Whereas the successful investor invests in a broad spread of assets to a level of risk that they're comfortable with, and they invest with patience and discipline, knowing that markets go through cycles, they rise and they fall. But because they've got a long-term view, they don't worry about that. When they're at the bottom, they just hold their time and wait for markets to recover. And this year has been a classic example of that, because after Liberation Day with Donald Trump, when he announced the global tariffs around the world, the stock markets and the investment markets tumbled. We had a good week of falling markets, and a lot of investors panicked and sold. But as I record now in June 2025, the S&P 500 as a gauge is nearly back to where it was at the peak pre-Donald Trump's announcements. So those who have stayed the course have seen the value of investments return. So in summary, when it comes to long-term investing, gold doesn't stack up. It's more volatile than the stock markets without necessarily the same returns to reward investors for that volatility. And when you're looking at investments, don't look at just one single time frame, because it masks a lot of ills. And ultimately, diversification with patience and discipline is the best way to long-term returns that will help you achieve whatever your lifetime priorities are. And if you're going to use gold, I suggest it's better to be used for decoration, for jewelry, than trying to chase returns and get positive long-term returns for your money. If you're going to do it, maybe 5 to 10% maximum of a portfolio, but I would tend to prefer investing in the global stock markets at a level of risk that I'm comfortable with.
I hope you liked this video. If you did, please click on the thumbs up button. If you've got views, opinions, experiences that you want to share, please do leave them in the comments section. If you want to receive more videos like this as and when I produce them, please do subscribe. And if you want to know more about how I help my clients plan and live their ideal retirement free of money worries, please go to neliganfinancial.co.uk. In the meantime, thanks for watching.
And just to finish with the compliance bit, so this video doesn't constitute advice, can't rely on past performance as a guide to the future, and whenever investing, you may get back less than you put in. Thanks for watching.